Hi, Steve Sosnick here with today's Interactive Brokers midday market update for Wednesday, July 1st, 2020. First day of a new month, first day of a new quarter. I'm outside today because it's an absolutely gorgeous day here in Connecticut, and I figure it's a holiday up in Canada. Happy Canada Day to all our Canadian friends. So it's a holiday somewhere, so I'll take advantage of it and enjoy some of the good weather for a few minutes. As far as the markets go, another day, another rally, although much more muted than what we saw the last couple days. It's really hard to top that. Most of the character of the market of what we saw was sort of the gentle uptrend and then a little rocket ship right into the close. That tells me that there were both buy programs and people marking their books, let's call it, adding to positions that were winners going into end of the month, end of the quarter, booked settling. You sometimes see new money coming into the market first day of the month. It tends to be an up day. Not necessarily statistically significant, but just sort of the pattern is that it tends to be up. And so it doesn't surprise me to see it, although rallying a little bit. And you could tell from the futures, they were lower most of the morning. And then about, 9 o'clock or so New York time, they just shot higher to lift higher. And there hasn't been a lot of follow through. But you could see that there's people still following the momentum in the U.S. Some of the stuff we talked about earlier this week, whether it was going to be a tug of war going into quarter end between pension funds that needed to rebalance and, let's say, other funds who wanted to, window dress, I guess is the appropriate term, the politically correct one certainly. And clearly the window dressers won. I don't really think there was that much pension fund rebalancing. I was always a little bit skeptical of it from the beginning because it wasn't clear to me what compelling evidence there was for pension funds to need to rebalance. Yes, their equity holdings have outperformed, but their bond holdings have done very well, and the yield on those bonds is pretty lousy. So there's really not a ton of reason to be moving your money out of equities into bonds if you're a pension fund with a long-term focus on strictly on mechanical reasons. If you want to do it for valuation or other considerations, of course there's always a rationale for moving money around based on whatever it is you're looking at. But mechanically, I didn't see it. I do remember sort of the first time I remember the big asset allocation trade. I just started in the business. It was 1987, and there was a big deal. It was whichever pension funds did it proved to be brilliant. But I remember it was one of the state pension funds, and I was at Solomon Brothers at the time, and we handled the trade. I had a very, very minor role in this, probably just executing a few trades on behalf of the customer. But apparently one of the pension funds had said equities are crazy value and bonds have very, very high yield, and let's move out of equities into bonds, and whoever did that was genius because they beat the crash. I'll argue in some ways they almost precipitated it because it took someone huge to sell it, but I don't blame them for it. They were just taking advantage of what they saw in the market. But that leads us to look forward. Enough history for now. Let's look forward. As I've written about, I think the market really has to get the number it needs tomorrow for the employment numbers, for the payrolls report. Remember, it's coming out on the first Thursday of the month. Normally it comes out on the first Friday of the month. But since Friday is a holiday here in the U.S., they've accelerated it rather than push it back. And the estimate is for an increase of about 3 million jobs today. The ADP number actually came in more or less on their consensus. It's an okay read. On the other hand, there was a nice revision upwards there, so that probably provided some of the lift to the market today. Some of the numbers that have been coming out have been beating very low expectations. But the problem you have is the rally that we've seen in the past couple of sessions means that the room for error is lower for the market. Think about what I mean here. If we'd come in sort of at what I would consider a neutral range, and I'm talking strictly from a trading point of view here, if we'd come in at a more neutral range, sort of trend line type of trading, the market could more or less react one way or the other, but have some room if the number's disappointing. If you've rallied sharply, and if a lot of that rally has been predicated on end of quarter window dressing rather than real fundamental valuation change, then you've got room to fall if the number is disappointing, or you can argue that a certain amount of the good news has been priced in already. Not sure that the market is thinking that rationally, quite frankly, lately. I think it just reacts to price and moves higher, or reacts to a number, says it's better than expected and moves higher. There's not a lot of selling, so I think the buyers are in control still right now. But that narrative could change based on a major economic number. And as we've discussed, if you have a reading that's too good, you're going to start to hear the chorus come out about why we don't need more stimulus, why the market's doing fine, the economy's doing fine, jobs are doing fine, so why do we have to put more stimulus in people's pockets? I'm not going to get into the politics of it, but the market wants and needs more stimulus. The market continually needs new money flowing into it. On the flip side, if the number stinks, well, the number stinks, and you might get your stimulus, but careful what you wish for there. So you kind of need a number that's around consensus, that keeps stimulus on the table, keeps the voices who are against fiscal stimulus kind of in the minority, and that would allow something to happen. And I think that is the most market-friendly choice. So the markets kind of has to thread a needle, and I think the margin for error was reduced considerably by the sharp moves we've seen higher in recent days. In any event, it's going to be a long weekend after the numbers released, so we'll catch up on where it is tomorrow and start to look ahead for a 3-day weekend. Take care, everybody. Bye-bye.